Okay, we are going to start. First of all, thanks everybody for coming tonight. It's going to be a great event. It's a big honor for us to host this event. Usually, the Roth Center for Corporate Governance is doing many programs, but we have neglected a very important part, which is venture capital in earlier stage. Some of you may recall that in 2010 we did a program called JDs as Entrepreneurs, and that is a very well-attended program. Everybody liked it. The students have been clamoring more from it. And so today we're very happy to have JDs as VCs, and it's a very interesting part of the education or the career path that lawyers can take. So it is a little bit different than our usual programs, but it is a very exciting program. And we have today a very interesting panel of people that have different investment criteria or career paths, and I think it's going to be a very good feedback for all of you. I think what we want most of it is for you to ask questions. There's going to be half an hour of questions. We're going to have a short introduction from each of the panelists, and then maybe 5 minutes from each telling you about their path in as a JD and then into venture capital. And so we're going to talk half an hour about each of the panelists, and then we want you to just ask the questions that you have. And thanks again for coming. And maybe we'll start with Scott. 5 minutes introduction, and then we'll just revert into your investment criteria as Andreessen Horowitz.
Great. So first of all, thank you for having us. I'm a 96 graduate of law school as well as an undergrad, so it's always good to be back here. So before I jump in, I guess maybe I'll start with a little bit of controversy, which is my main message today is actually don't go into venture capital is the position that I'm going to take. And I mean that not because venture capital isn't a great job, which I love, but I think from to me, there's two things I think it's really important for people to understand, and I'll be interested to hear whether my colleagues agree or not. One is that, so the reason I say that is this is a cottage industry. It's a very small business. There are very few number of venture capital firms, and and I think at least if you believe the trends that you see, I think the number of firms will probably shrink over time. Although the dollar seems to be fairly constant. So it is it's also a business where returns are very skewed into, averages don't mean a whole lot. Returns are fairly skewed, so I think it's a hard place kind of to start. The other thing is really more is it's a very hard career path type business. So I see a lot, particularly more from the business school. A lot of people coming out of business school who want to be venture capitalists, and I always start them with the same admonition, which is if you want to be a venture capitalist, that's great, but go have a career first and then become a venture capitalist. We can talk a lot more about that in depth, but I was an investment banker in my first life, and career pathing and management in venture capital makes investment banks look good at management, which is not a compliment. Anyways, just something to at least start the discussion going. By way of background, as I mentioned, I was an undergrad at the law school. Undergrad here, went to law school, and then I decided after going to law school and clerking that I had no interest in practicing law, and so I ended up in investment banking. I was at the firm formerly known as Lehman Brothers back in the late 90s, and then at CSFB when Frank Quattrone and group were there. So it was kind of a very interesting time to be in the Valley doing a lot of financing work, a lot of M&A work. And I just randomly got introduced to a guy named Mark Andreessen by one of my clients when he was starting a business called Loud Cloud back in the late 90s, which, as we used to joke, was we were cloud before cloud was actually a cool thing to be. We were, at a minimum 10 years and probably 20 years too early for that business. It turned into a, incredible roller coaster ride. We ultimately sold the business to Hewlett-Packard for about $1.6 billion in 2007, so it worked out quite well. From a career path, though, what that gave me was it really gave me the opportunity to go into a company at the ground level. Initially, as coming from a banking background, I was there to actually help them raise capital, to run a lot of the finance functions. But one of the beautiful things about living where we live and being, having the opportunity to get exposure to companies is if you get in at the ground level and you demonstrate expertise and competency in a particular area, companies are much more willing to gamble on you in terms of areas where you have absolutely no expertise. So I went from running a finance organization into running a field organization, which was managing a global professional services and pre-sales and support organization for an enterprise software company, which to be frank, I clearly had no expertise to be doing. And then I stayed at HP once we sold the business there and ran the support business. And in late 2008, Mark Andreessen and his partner Ben Horowitz, who was the CEO of the company I had come from, decided they wanted to actually get out of the very cottage industry of angel investing and do this institutionally. And so I joined them when we started the firm, which was in 2009, and we're now going on just about 3 years in this business. From a firm background, we are kind of a multi-stage IT venture capital firm. So we will do a $50,000 seed investment all the way through to, to date, our largest growth investment is about $95 million. We focus in two core areas of IT. Traditional infrastructure IT, so think of that as storage or networking or applications, cloud virtualization, all the stuff that is critical to a business running their enterprise. And then we also focus on consumer internet. Unlike I know some of the folks here, we don't have expertise in things like clean tech or life sciences or healthcare, and so we've kind of chosen to stay fairly focused in our area. We're pretty parochial, I would say, from a geographic perspective. So also I think where we're a little bit different is everybody in the firm actually works in and out of this office, and while we have done and will continue to opportunistically do deals that are outside the area, we probably have more of a bias than others about the kind of utility of being a Silicon Valley focused firm, and think there's a pretty unique environment here that allows us to kind of see very interesting opportunities. So we don't, for example, have a China presence or an India presence, and those are not normative statements about the investment opportunities in those areas, but just more a reflection of kind of focus and where we like to spend our time from an investment perspective. We are, as I mentioned, just about 3 years old. We've kind of over 3 funds raised a significant amount of money, about $2.7 billion, which certainly I think for a new firm is quite a bit of money. We've done that, I think, because I think we've been able to do that because we've taken a bit of a different approach to the venture business. For those of you guys who are familiar with venture, the traditional model, at least for many years, has been you have a collection of general partners, and then a general partner is essentially the kind of responsible for 8 to 10 portfolio companies, depending on what he or she is doing. What we've tried to do is disaggregate the general partner role from the rest of the network building and kind of value-added services that we think we can add to a portfolio company. So the way that manifests itself is we have 50 people today in the firm, only 6 of whom are focused on actually investing and sitting in boards. The rest of them are divided into vertical organizations, and their job is, in your respective domain, build relationships and networks that can be valuable to the firm and valuable to the portfolio company. So as a concrete example, we have 6 people today who focus on what we call market development. Their job is build relationships with Global 2000 companies that can be either customers and or business development partners for our portfolio companies, and then where appropriate, obviously connect them to the portfolio companies to help augment sales efforts as they may otherwise be doing on their own. So it's a little bit of a different model that kind of, at least we think, makes us able to be more efficient and deliver, hopefully, value to our portfolio companies and, potentially, distinguish ourselves from other folks in the industry. I think I've probably hit my 10 minutes, so let me turn it over.
Okay, thanks.
Hey, my name is Miriam Rivera, and I'm co-founder of Ulu Ventures, also co-founder of Stanford Angels and Entrepreneurs, which is an alumni group here on Stanford campus for people who are interested in angel investing and entrepreneurs who are interested in networking with potential angel investors and advisors. I am not a venture capitalist in the sense that I don't invest other people's money. So I am not a fiduciary of other people's money. I invest my own money, which came from Google, in case you're curious. I was a scholarship kid here at the law school, so it wasn't from family money. But I started doing angel investing actually quite a long time ago, back in the I graduated in '95 from the JD MBA program, went to work at a law firm with Josh Green, actually, where he was a partner at the time, and then went to management consulting and eventually did the startup, co-founded a startup in the late '90s, and worked at another startup after that before joining Google when it was still a pretty small company, about 160 people. I was a second attorney at Google and basically helped them figure out a lot about their monetization of their traffic during that time. And a lot of the focus I had was on building their business-to-business relationships and building out the legal function for the company, which went from 2 people to about 160 people over the 5 years that I was at Google. And we went from 85 million in revenue to 10 billion in that time. So when I left, I was vice president and deputy general counsel for the company. And I would say that I agree with Scott in the sense that if you're thinking of doing something like venture or angel investing, I get a lot of people who are trying to do it straight out of school. I think you really should go in depth in something. I know in the engineering school they talk about T people, and what that means is that hopefully you've gone really deep in one area of expertise and you have a breadth in other areas of expertise. And I do think that that's important because being a venture capitalist or an angel investor, hopefully you do develop a rather narrow kind of scope in terms of what you're looking at in terms of deals and kind of focuses for your investment interests. Because there's just obviously more people that would like money than there is money in the world. And so if you don't have a very good focus and have some expertise and depth in that area, I think that it's pretty difficult to really see enough of the kind of deals that you'd like to see and be able to qualify them well. And so having some expertise of your own and or industry experience, mine has all been in the IT area, and I invest only in IT companies, although I do some in education technology and online education because that's been an area of passion. In fact, my first career was in higher education. So when I think about investing, I really think of it as an activity that you can do either on a kind of part-time or a full-time basis. When I was working in the 90s and investing as an angel investor, I was doing that mostly with friends, to be honest. Like, they were my classmates from places like Stanford Law School and Business School. I think I did pretty well in choosing that population of people to invest in, but I was doing it on a pretty limited basis. About 4 years ago, I started doing investing on a full-time basis, and I have also become a member of the Kauffman Fellows Program in order to gain more expertise in how venture capitalists look at deals and diligence and term sheets and all of that. Because even though I had practiced corporate law and worked with high technology companies here in the Valley as an attorney, it is a different mindset and a different point of view that you're in how you're looking at companies when you're looking as an investor versus an attorney working on the same documents, if you will. So I also would not want to be a venture capitalist, not because I think it's, well, it is a shrinking industry, and one of the things that I feel has been helpful to me in my career is to go to work in growth companies. That has given me, I think, a much more deep and rich experience than I would have gotten if I had worked in shrinking industries. And for me, for example, when I compare some of the experiences that I had working in startup companies, I had so much more experience more early in my career than many people who worked at other kinds of companies. I worked with boards very early in my career. That's one of the things that's associated with success, especially for women in business, and also having had that experience is very helpful from the point of view of working in venture, because that's a big part of what you're doing. And so if you've had the opportunity to work and observe with good boards, I think that that gives you some experience that is often lacking for people that are just starting out of business school as an associate at a firm. So I think that the fun aspects of working in venture for me are, one, having the ability to work with really interesting people. Entrepreneurs are the most fun people I think you could probably work with on the planet. Also, being able to combine areas of passion and interest in a professional, like for me, education was always an avocation. I'm a big volunteer at Stanford. I serve on the trustees. I serve at the business school at the GSB Advisory Council. I've served on the board of visitors here at the law school. And I've had many, many committee roles. But I never really thought of it apart from becoming a professor or working as an advisor as I did when I graduated from undergrad, that it would be something that I could combine with my love and passion around the intersection between law, business, and technology. And now with online education and education technology, I find that it is something I can have as an investment thesis, and that I can become quite adept at finding the right kinds of companies and the right kinds of entrepreneurs to invest in. So that's been one of the reasons why I've decided to focus in the last few years on angel investing. And there really is an opportunity, I think, to have an impact that's a little bit different even from working in a startup company, which if you're lucky to work at a place like Google, you have a tremendous impact. And that's one of the most fun experiences I think anybody can have in their lives and their careers, is to work with a company that really changes how people do their everyday life. But most of us don't have, there aren't too many Googles that you can become part of every day. And so for me, it's been kind of interesting to invest in different companies and have that portfolio where, if some of them don't survive, some others do, and some others thrive. And that's been a really nice way to expend the time and energy that you do in your career, compared to other times when I've worked at startup companies where, you're working your 60 to 80 hours a week and it fails and you've spent, a lot of time and effort. And even though you may have had a tremendous learning experience, it's always discouraging and a bummer when that happens. So it's nice to have different things that you can look at and that do succeed. And then just in terms of the number of companies and jobs that you can create as a venture investor, it's really exciting to know that you're actually doing something that makes for productive communities.
That's terrific. Well, I didn't expect to be the contrarian here to say I actually like being a venture capitalist, but nonetheless, let me just tell you a little bit about my background. And I'm also, I think, a contrarian, and I'm probably the only person who didn't go to Stanford who's sitting here today. I graduated from UCLA undergrad and law school in 1980. My law review article and my entire focus was on becoming a real estate lawyer. And I wrote my article, my law review article, Invested Rights in Real Estate, which had a terrific professor and all the rest of it. And I showed up at my firm, Rembe, Pfleger and Harrison, up in San Francisco, and there was no room in the real estate department. So I really didn't want to be a litigator, and I ended up kind of bouncing around and ended up in the corporate department. I thought, well, this is better than litigation, but we'll see how it goes. Never heard of the Silicon Valley, poli-sci background, nothing that would qualify me to work in this valley. And within a year, I was working for what I call one of the 4 founding fathers of Silicon Valley legal practice. In addition, these names may or may not mean anything to you. You'll know one of them for sure, Larry Sonsini. That's not who I worked for. There's another guy named Jim Gaither, who now is at Sutter Hill in the venture capital business, is the head of Cooley Godward. Another guy named Bruce Mann, who at the time was at Pillsbury Madison and Sutro. That's what it was called in those days. And then finally, John Larson. And John was my mentor and introduced me to the Silicon Valley. And so after a year or so, about 1981, I was pretty frustrated because I realized that I was too late to the Valley. Everything that had happened had already happened, and I wasn't going to be involved in any of the really cool things that had already gone on in the Valley. So little did I know, and I moved down to our Palo Alto office, which at the time was 2 lawyers, and spent the next 15 years getting that up to about 150 lawyers in 1995 when I left. And I had decided at that time that I wanted to take the legal profession and turn it upside down and on its head. And Craig Johnson and I co-founded Venture Law Group. And we had learned a lot. Craig was at Wilson Sonsini, and we learned a lot at those 2 firms, Brobeck and Wilson Sonsini. We decided to do everything opposite. So we had been very schooled and experienced in having the associates march through the halls with torches, threatening to burn the place down unless they got a bonus. And we decided to give them a bonus when they least suspected it. We decided to limit the number of hours and limit the number of clients that we took on so that we'd have great service for each one of those clients. we decided to focus on equity rather than on billable hours. One of the unfulfilled promises I had was I was going to blow up the billable hour within 3 years after joining the firm. That did not happen, much to my chagrin. But that certainly was the prospect of doing that. So I had a terrific time there. It was just it was a magical experience, and it was for the we built that up to about 150 lawyers, and it was truly a magical place for not only the lawyers but all the employees there. We gave everybody a interest as if they had a stock option in the law firm, and so I decided that in I guess it was 2002 to start my new adventure, which was to work with the greatest startup that I will ever work with, and that was a high school basketball team. And I became a coach of a high school basketball team that had been languishing for 20 years, and myself and another coach, and he deserves a lot of the credit. We ended up winning 5 division titles in a row and 2 regional titles in a row, and I'm very proud of that, and it will always provide me the greatest internal rate of return that anybody can ever have. So in 2006, I'm sitting on boards and I'm having a pretty good life. And someone from Moore Davidow. And to give you a little bit of background about Moore Davidow, it's a firm that's been around for 28 years. We have about $2 billion under management. We're in our 9th fund right now, which is a $700 million fund. And we invest in IT, life sciences, and clean technology. And I got the call to say, do you want to go into venture? And I had said no politely several times, but there was something about this clean technology stuff that really interested me. I wanted to test out and see whether or not it was the internet.com boom of the late 90s, which I found to be a phenomenal time, but a little fickle, to say the least. Or was it the Silicon Valley of 1980 that I'd come into, where there's fundamental change going on, and we were changing things in a really meritorious and meaningful way? And after 6 months, I looked at it and I said, yeah, that was pretty interesting. It was more of that meritorious side of things. And so 6 years ago, I came into the firm, and I started investing in clean technology. Now, another part that really interested me about venture was that you were much closer to being a protagonist. Now, I always believe that the entrepreneur is the ultimate protagonist here, not the folks who supply the money or anything else. But I do have to say that there's a change in a role between being a service provider, a pure service provider, and being part of what I'll call the main cast of characters in creating these startups. So for me, personally, that was a lot of the lure to be able to do that. Now, the other element of it, and this has been true for my entire career, is that I've been in an endless search for fun and fulfillment, those two things. And this is how we used to take clients on at Venture Law Group, actually. So it's all about being able to maximize your fun and maximize fulfillment. Fulfillment sometimes is a dirty little word for making money, and yes, it is that, but it's also about pushing things along a little bit further as well. And so this has provided me a terrific vehicle to be able to do so. And so I've very much enjoyed my time as a VC, but the profession, as you've already heard, is definitely changing. And I think it's changing for the better, but it's in rapid period of change. And therein lies the opportunity. I think both Scott and Miriam have taken great advantage of those opportunities that are starting to emerge as the classical, small group of venture capital firms that manage X amount of money. You have to pass through their halls to get, anointed as a venture-backed startup and all the rest of it. That's all starting to disappear. So the opportunities to come into venture capital, or to become a super angel, or to become an angel, or to really become a collaborator with a startup in terms of making that happen, are really starting to decrease. Another side of the equation is that on the strategic side, things are starting to also start to emerge as strategics, especially in clean technology, are leaders, where venture capitalists are looking for the validation by industrial corporations of the technology before the venture capitalists will even invest. That's a very big change from the way things were even 10 or 15 years ago. So I'll stop here. And,
So I guess the one question a lot of students have asked me is how does the skills of having gone to law school translate into venture capital? I mean, you are an exception among your peers in VC being lawyers. I mean, do you think there is something that is good about having a GD that benefited your experience? I mean, what can you say about that?
Yeah, I'll start. By the way, before I answer that, I just want to make sure I'm not being misquoted by Josh. So,
I'm sorry.
I didn't say I didn't like being a VC. I said but the serious point is, I think it's VC. The point I meant to make, which I may not make clear, was it's a very hard career to start off in as a young person coming out of school. I do think very strongly, and I think Miriam echoed a lot of this, that it is more of a career, as you've heard from people like Josh, where it is it is a very good second and third career. It's a very hard career progression path for somebody coming out of school into VC. So I apologize.
In fact, there is no path.
Yeah, there really is no path, right? Yeah. So I think on the legal side, it's been hugely valuable to me throughout my career. So I think probably with the benefit of perfect hindsight, I'm not sure that going to law school for 3 years and never practicing law was a super smart decision. But I've met some good friends, and some of them I see here. But either in a banking world or in a VC world, right? I mean, at the end of the day, the world is transactions, right? So everything we do day to day in our world is, we're doing fund formation work, or we are doing, venture financings for companies, or we're helping with board governance issues, or we are, thinking about corporate development partnerships or business development partnerships. And, there are relationship components to those, and there are also like, do you understand the business issues? Can you distill them in a way that makes sense? Can you help other people on the business team understand what legal risks are that they're doing? So I'd say, I wish, I can't say that I planned it this way, but there's no question in my mind that foundational skill set that you get in law school translates, all the time in the venture business, certainly.
I would say that for me, there's been a lot of advantages. Obviously, I was a practicing attorney for most of my career, and although always in kind of startup environments where I really do think that you wear both hats, and the JD MBA was extremely beneficial in that context. And so for me, one is the training as a lawyer is very helpful from the point of view that you really do understand thoroughness. And so when you think about, like, you probably have worked doing due diligence, and I remember being a first-year lawyer doing diligence and having boxes of files for initial public offerings and going through them with a fine-tooth comb, writing up my memos. And one is, that process of diligence is still something that you continue to do as a venture capitalist, and you have a sense of what it is that you should be looking for, in part because you have been a lawyer. I wrote the schedule of exceptions. I had to do the documents that you still use as a venture capitalist or as an angel investor as well. You negotiate things all the time, so all of that kind of skill set is very helpful. I've obviously been a transactional attorney, but I do think that one of the bigger focuses of how I did my practice was about building relationships, because a lot of the relationships that I built were business-to-business partnerships that endured for decades and are very beneficial relationships for each company. And so I have a very more partnership-oriented focus in terms of how I think about things. And from an investor perspective, I actually think about that as well, because many people have the good fortune of developing relationships with entrepreneurs that endures over various companies, and that can become actually more and more lucrative over time as an entrepreneur gains experience. Or sometimes it's true that there are a lot of first-time entrepreneurs that are very young that actually have their biggest home runs early. That happens as well. So being an angel investor, you can have access potentially to that group of people as well, because they're very often young and inexperienced entrepreneurs that are looking for a good personality fit to build a relationship with, looking for people that have skill sets that they think they need to help build their businesses. And I think the intellectual horsepower that you get from practicing law and the care that you use in how you practice law are things that serve you well as a board member. Certainly having that background of corporate law, the kinds of courses that you take in law school, you really are exposed to understanding what your duties are as a director, et cetera. So I think it's been very helpful in very concrete and specific ways. And I definitely think that it's also just been fun to be able to incorporate a lot of the stuff that I didn't think I would be practicing corporate law again after I left Brobeck Flager, and then of course ended up doing public company practice at Google, and then now doing private company board work. And so it's been very fun to have it apply across my career.
Yeah, I completely agree with the comments that have been made so far. Let me just add a couple of things to it. One is that the law is a service business. You are providing services to others, and you learn how to become a service provider. The venture business is differentiated on the basis of being a service business. I think you heard Scott describe how his firm does this, which is in a very service-oriented way. And the rest, and that's how firms really become successful, because we're all got the same product. It's a checkbook and stuff, and so you've got to differentiate on the basis of service. The second is really to echo what Miriam said, which is that we learn skills of facilitation. I mean, successful lawyers are successful facilitators, and that's an incredibly important function to serve in what can be at times a dysfunctional family, which is how a startup grows and develops and changes, usually on an hourly basis. And the last thing is experience. When I was a lawyer, I never really kept a count of this, but I did an estimate once, and I realized that I had done over 1,000 venture capital financings in my career. And that is by a factor of 10 more than the most experienced venture capitalist in the history of Silicon Valley has ever done. Now, that doesn't make me the world's greatest venture capitalist, but it does have a tremendous base of experience. And it's really something that allows you to leverage that in the venture business itself.
Okay, great. Well, we'll open up to questions. Just come up and we can start with the questions now.
Hi, thank you for coming. Hello? So you all have portfolio companies. You admonished us not to go into venture capital directly. So you all have portfolio companies that require legal services. Can you talk about how you provision legal services for the portfolio companies? It seems like that would be one of the best ways to gain the experience needed to be a venture capitalist. So maybe how do you provision legal services for your portfolio companies if it is different across the way, and then what kind of skills are portfolio companies looking for as they go out and hire attorneys, and at what stage of growth are they when they hire their first attorney? Thank you.
We certainly don't provision legal services on behalf of our portfolio companies. When asked, we often will make recommendations on people to work with. I think there's a tremendous, the great news about, again, being around here is there are a significant number of firms who this is what they do day in and day out, and so there's lots of choices for that. I think in terms of when companies kind of get to a decision to bring somebody in-house, I think it depends a lot on the nature of the business. So, we do a lot, for example, on the consumer internet side, and I'm starting to see more and more companies earlier on think about bringing counsel in-house because they have kind of complicated and unclear issues around intellectual property rights, around regulatory and privacy and compliance type issues. Whereas at least on the enterprise side, so if you're a traditional company selling into the enterprise, it's not to say you don't have those issues, but I find a lot more of the work, the legal work tends to be more transactional type work, which I think you can utilize law firms probably for longer to do that work before you bring that skill set in-house. But it's definitely varied. It's particularly in the consumer internet area, we're seeing companies earlier than I'd previously seen bring in-house counsel in specifically to deal with, again, privacy and IP-related issues.
What type of revenue level?
Sometimes zero. Many times zero. because we've got a number of them. They're all publicly disclosed in terms of the companies. But there's a lot of consumer internet companies who may have no revenue today, but who have tremendous breadth and scope in terms of kind of geographies that they're in all of a sudden, right? All of a sudden you've got international issues before you anticipated it, and also you now have privacy, regulatory issues, copyright issues, all kinds of stuff that may predate you ever actually even generating a penny of revenue. So it's really more a function of scale and scope of the company as opposed to financial.
So also, obviously, I don't practice law on behalf of any of my portfolio companies. I often am a first responder to questions about legal issues, though, and often help them try to think about what kind of questions to ask as they look for counsel, evaluating counsel, recommending counsel. Also, I totally agree that a lot of our companies have really complex legal issues kind of early. So, for example, crowdfunding space is one where we were a little ahead of the curve in terms of the Jobs Act, and also very influential in terms of trying to influence that legislation through a very small startup, actually, that was able to get hearings with SEC commissioners, with senators, et cetera, and partly through my own relationships. And so it wasn't good enough to save them for another day, unfortunately. But it's been fun to apply some of that legal experience in this environment that companies find themselves in. Geolocation types of services often have privacy issues, and so we'll have mobile companies that are hiring some of the most expert people in privacy law out there. And I think that that's a common thing to consider as you're building a startup. If you're doing things with financial services, for example, you should definitely be getting lawyers early and often. You may need to get special opinion letters for example, it would have been helpful if the startup had gotten an opinion letter so that when the Department of Corporations came after them, they would at least have had some good basis for making an argument that they were complying with law, other than the fact that they had hired an attorney in-house very early. So I think that there are often times when the nature of the business that people are in makes it so that that background and your awareness of the types of issues and the kinds of relationships you have may be beneficial to particular companies. But it's certainly not true across the board. But in areas like geolocation, crowdfunding, finance, those have been the areas where I've seen it be the most beneficial.
So I agree with all of what's been said. I would add another element to it, a perspective on it. You can't hire a lawyer for a startup too soon. And in fact, at places like Venture Law Group, we used to say our paradigm client is two guys, a computer, and a dog. And the reason is that that lawyer goes well beyond providing legal services. They provide a really Sherpa guide role into the financing process for the startup. And they provide, if you've picked the right individual, an unbiased source that can provide wisdom well beyond what the experience level is of the typical entrepreneur seeking funding. They can guide them to the right sources for funding, whether it be angels, super angels, venture, whatever. They can also provide that unbiased wisdom of how to bob and weave during that process. And it really just cannot be overstated how important that is. And the law firms who have been successful here in Silicon Valley have all done that work on the come. They've all looked at it as an investment that they make in order to develop their base of companies. And most of the most successful companies have come out of that process. So that additional role of counseling, of what doesn't seem to, on its face, to be anything about what one would have learned in a law school class, is an incredibly important function, almost necessary in a sense. To do that. So we receive a lot of our referrals from lawyers and law firms. So.
Well, what about the state of venture capital today. I mean, maybe you can comment on that. It's something that's interesting. Usually it's great to hear from VCs, what's going on. I mean, we're seeing, big valuations, so it's something that maybe you can comment.
Yeah, I mean, I'll offer you guys a stat here, and you'll see what we're talking about in terms of the industry itself. So, in the first quarter of this year, venture capitalists spent $6 billion on startups, but only $5 billion was raised by venture capital funds, and that's not a trend that's just isolated to the first quarter. And a little more of this, and venture capital will look like the United States Congress spending money. You just can't continue to spend more than you take in, and the like. And so the category itself is really under some significant threat right now. There's a feeling that let me actually describe who invests in venture capital firms, besides people who can afford to do it on their own. And we're more of a traditional base, and it'd be interesting to hear how Scott, his limited partner base is, but we've raised the vast majority of our money from endowments, university endowments, and private foundations, and some of the largest private foundations and largest universities in the world, including maybe one that we sit in right now. So, and it's all a virtuous cycle, because 40% of the deals that we do come directly out of university labs. And so we're making money to ultimately send that back to the university and the like. That has been the traditional model. That model is now breaking down. It started to break down even before 2008, but the financial crisis accelerated that significantly for a variety of reasons we can go into if people are interested. And as a result, the entire fundraising process for venture capital is changing radically. Now, the other part of it is the penance that had to be served by the venture capital industry for overinvesting in the dot-com explosion, so to speak, has now come home to roost, because the industry tends to work on 10-year IRRs and things along those lines, and those are not looking so hot right now, based on the last decade of venture capital investing. Now, I happen to believe we're in absolutely one of the great times to invest right now, but you're hard-pressed to get risk takers in that area as well. So the nature industry is very much changing, and it'll be interesting to see how it evolves, but I don't know what you guys think.
Yeah, so I mean, our investor base is very similar. So university endowments, foundations. So names that you would recognize who are foundations. Some family offices. So kind of individuals or families who have substantial wealth, that may be intergenerational wealth. That's the major group. I agree with everything Josh said. I would the one thing I'd add, which I think also is what's happened, I think, in this industry, is a lot of the money that came in from these traditional limited partners was because people viewed this as an asset class. So people said, look, for those of you who are interested in this stuff, there's a very well-known person, Dave Swenson, who runs the Yale University Endowment, who has written extensively on this and actually teaches at Yale School of Management. But he's created something called the endowment model, which a lot of endowments and foundations have decided to use. It's really an asset allocation model, right? So it says X% of your money should go to hedge fund and alternatives. Some of it should go to fixed income, and as part of that endowment model, there was always this concept of private equity as a bucket also for an asset allocation. And I think what at least people learned over the bubble and certainly the ensuing years was that venture capital kind of goes back to the first comment I said. Venture capital is a little bit more of a cottage industry. It's not really an asset class, and if you look at returns over time, they again tend to be highly concentrated in a relatively small number of firms, and you can argue if that's 15, 20, or 50 or 100, but it's not 400 or 800, which was kind of what the scope of the venture business got to in the kind of heavy days. So I think the other thing that's happening is a recognition by limited partners that if you can get money in the firms that you think are good and can deliver great returns, then you ought to put that money in. If you can't, though, you ought not to go just put it into the other firm. Basically, you ought to basically just say, look, I'm not going to have an allocation to this asset class. So I think that's part of what at least is driving some of the numbers in this business around kind of lesser dollars coming in relative to dollars going out on the investment side.
One of the things too that I've seen at Kauffman, which has been kind of interesting, and it has to do with this idea that it is a cottage industry, is that one, many people get into venture through some odd circumstance, right? And so one, it could be that you've worked a lot with a firm and you've developed relationships with the partners there, et cetera. But the weirdest of things, like one of my classmates got into venture because he came from a country where there was a billionaire who wanted to invest in Silicon Valley. He happened to be from that cultural group and know a professor of the same cultural group at the Stanford Business School. I think he got $200 million to start his first fund. Is that random? It's random. And so many people have been an entrepreneur with a venture firm and then become EIRs. Sometimes they actually end up working at the firm itself. And in addition, I do think that because it is a cottage industry, even though the industry as a whole is declining, there are always new funds being started. And they're always, if you can find a point of differentiation and you have something particular that you think you can offer the market and that people can get excited about, then people can raise funds. So one of our classmates from the Kaufman program raised a fund with a Palestinian and a Jewish founder to invest in the West Bank. And in part because there's a lot of talented, educated people who, for safety, don't go around the streets, but they can do internet work, and so there's industries that they think they can have access to that other people from other countries won't have access to, this class of entrepreneurs, and that they can actually do things that are lucrative within that geography. And also there are people that from an impact investing point of view want to be able to influence that market. So people can find points of differentiation and raise very large funds even in this climate. And so if you have something very special, I don't want to discourage people from kind of pursuing that because it's what you can make of it.
Hi, I have a question about each of your investment screening processes. I wonder if you could just talk a little bit about what they are, each of you, and if there is anything, perhaps sort of riffing on Evan's first question, that you think your legal background helped you in creating the screen that you currently use, or not?
Yeah, I'm not sure in that area of the legal background. So our screening process is, I don't know if I would call it a screening process, but at the end of the day, I guess let me turn the question around, which is what do we look for when we're investing? It is really, I think, the other way I'd rather answer the question. So, number one, it depends on the stage of the company, but for early stage company, what we're really looking for is, is somebody building a breakthrough product in a market that, if they're successful, is big enough to actually matter. And what I mean by that is, we talk about this a lot internally, but building a company is hard, and for anybody who's been in there knows that it's the sausage making is ugly when it's happening. And so if you're not going to build something that at least is in a market that can be big enough and self-sustaining, there's a little bit of you're doing a lot of effort for potentially a small reward. The reality also, for better or worse, unfortunately, of our business is the winners are what drives all the returns in this business. So you have to you have to have enough of those big hits on the winner side to actually make the economics work in this business. But at the end of the day, at the early stage, fundamentally, it's breakthrough product in a huge market with an incredible founding team, right? And that doesn't necessarily, that founding team could be very different. It could be they have domain expertise in the area they're doing. It could be that they just have a particular product vision that's well articulated, and you believe they can actually build a team around them. But that's really at the early stage what we're really focused on. Obviously, if you get to later stage stuff, things like financial modeling around the business, all that stuff becomes a lot more relevant. But at the early stage, really, it's a more qualitative assessment around those three items for us.
I would say that the qualitative factors are very similar. In terms of approach, one, I think of the things that I would say is helpful from my legal background is the fact that I probably negotiated hundreds or maybe 1,000 if I'm lucky deals in my life. And so I had to learn how to read a lot from the information that people were transmitting that wasn't verbal. And so being able to get a feeling for people in different circumstances is very important to try to understand, like, am I going to have a good fit with this entrepreneur? Am I going to, do I get how this person thinks? How does this team work together? Those kinds of qualitative factors that can have a real big impact on whether a company implodes.
And that's all from your interpersonal interaction with the team.
Interpersonal interactions are a big part of it, and seeing the team together is a big part of it. And then more the business background probably than the, and the business school education more so than the legal education in terms of looking at market opportunity. But one thing that we do that's a little bit different and is a point of differentiation for us as angel investors is that we do have kind of a proprietary model that we use in terms of looking at venture investments that's based on decision analysis. My partner, who is also my husband, is a PhD in decision and risk analysis from Stanford. When I was here at the business school, I took courses in decision analysis in the engineering school where he got his PhD. And apart from Google, which is able to use the internet and the volume of transactions to be able to get data in a very statistically significant way, there's no statistical significance when you're dealing with the risks of making investments in startup companies. But what he is an expert in is quantifying risk under uncertainty. And so we have a model that we use that helps us to look at that market opportunity, and that involves the team of founders in the process of populating that model so that we can both understand some of the interpersonal dynamics. We can also understand their ability to reason and logically talk about their market and see their expertise in action. And so that is something that is helpful to us as investors.
Gee, is that available for licensing? I just add to the points that we've already heard and just a little bit of little extra on that. There's an old saw that basically venture capital investing is all about investing in three things: management, management, and management. And obviously off the real estate one, that location. And it's really true. I mean, the people are just absolutely critical. So having said that, let me go to a different analogy that we use, which is the three legs of the stool. And for my firm, remember, we're doing some big science projects too. And that's in life sciences and in clean technology. So we look at management or the team, we look at technology, and we look at markets. And for us, we need one of those to be almost completely de-risked. Okay, so typically in a clean technology startup, for example, I need to know that if I'm going to create electrons, and I'm going to do it in some, with using green energy, I need to know that I can sell those electrons into the market, and that market will accept them, and I know that that's taken care of. Now I can go focus on the two other legs of the stool: the technology, does it work, and what about team building? So we look at it as those three legs of the stool and gauge the strength of each of them. And you asked about legal background. I would like to think that my legal background has actually helped in the development of my judgment. And I have a very specific definition for what judgment is. I look at it as the application of common sense, which I think at some point life science researchers will find as a gene in people, and some people are gene deficient in common sense, but it's a gene, and so you either have it or you don't, and then you apply experience to that common sense. And it's the combination of a lot of experience with the common sense that over time develops judgment. And I'd very much like to think that that's what my legal career brought me, was judgment, because I think when you become a partner in a law firm, that's what you're being paid for by the client. You're not being paid to pour through the documents. You're being paid for that judgment. And that judgment starts to emerge as a senior associate, years 3, 4, 5 in a law firm. And then just further develops your whole life.
So there's a lot of talk of lack of IPOs and sort of secondary markets. I mean, how's this affecting the venture market? I mean, this is something we've looked at and tried to understand. And the lack of the exit strategies for VCs, is that real? Is this something that you're concerned about? Even the Jobs Act, I mean, how do you react to that?
Actually, Josh and I haven't talked about this, but so, the Jobs Act to me, I don't know if you guys follow this, but so the Jobs Act basically, kind of both made it, in theory, made it easier to become a public company. At the same time, it also increased the shareholder limit at which you can remain a public company, I think up to 5,000 if I remember correctly. So it seems to me there's actually a very interesting policy dichotomy there, and we were lucky to have a conversation actually with one of the SEC commissioners who came by our office the other day to talk about this. But there's a very interesting policy debate there, which is what is the SEC's role? So is the SEC's role to protect kind of the individual investor, in which case, in theory, if you believe that to its fullest, then you may migrate more towards a bifurcated set of public markets, right? So you may actually have the real public market, and then you may have the second market or the other things where you can have institutional investors who, in theory, the SEC doesn't care about, at least in their not that they don't care about it, but has lesser concern for kind of their well-being, depending on kind of how you interpret their views. So I think what's happened, at least I think some of the causes of this, at least in my view, are number one is there's no such thing as a small cap tech IPO market anymore. So one of the bad things I think that came out of the last bubble was you had companies going public, obviously very early. I looked at some data not too long ago. I think the average revenue for the class of 99 and 2000 IPOs was about $20 million, if that. When I last looked at the data in 2010, the average revenue for IPOs in 2010 was about $170 million. Now, that still wasn't talked to whether those are good, sustainable businesses or not, but I think there's a very discernible difference between the stage at which companies are going public now, and obviously Facebook is, of course, the talk of the town these days since they're going public this week. But historically, you have not seen companies stay private and kind of experience the kind of growth they've experienced in the private markets, as opposed to kind of using a public offering as a way to kind of raise capital and drive their growth. So I think the long and short of it for us, at least as we think about our business, is our view is there is no small cap tech IPO market. I do think things like Reg FD, as opposed to Sarbanes-Oxley, which increase the cost, but I think Reg FD, which I think, and the rise of the hedge funds also has dramatically increased the risk of being a public company with a small float and a relatively low market cap. I think we will see more and more companies stay private longer. The good news for, I think for people like us and, Josh and others who are, kind of playing across multiple stages is there a lot of the growth that you historically have seen post-IPO, I think you will see pre-IPO, which, means that you will, also see nominally higher valuations in this market because you will see companies staying private, for a longer period of time. So I think it's actually an okay thing and perfectly fine. I think, though, as a corporate policy issue for this United States, I think like the SEC has to decide, what is their charge? Are they there to protect the small investor, or are they there to, provide, kind of the ability for people to actually get access to companies? Because I think there is a very long-term trend here, which is it could be the case that you get this very bifurcated market where the only things that go public are the things that, the only things the actual normal investor sees is stuff that goes public in a, different market that where a lot of the growth has already been taken out of the prospect for that company. Sorry, it's a bit of a long answer.
I would say that the biggest difference kind of for me coming out of school in the 90s was that it was an IPO market. And then it became an M&A market, and at least there's the prospect of IPOs once again, which I think is a great thing. And in part just because returns on M&A tend to be smaller than returns on IPOs. So for the venture industry, it's a good thing that there is an IPO market again. The last 10 years have not been very good in terms of returns for venture investors, and there have been a generation of VCs that maybe have never taken a company public and have not been able to develop a track record. There's a distinction that we make in decision analysis, which is that you can have good decisions and bad outcomes. And so you literally have VCs that may have been very good VCs, but they weren't in an environment where they could actually demonstrate how good they are. And in this market, that's reduced the amount of dollars that go into VC funds from LPs. And so I think you need to have both M&A and IPO exits in order to have the, even if it's a cottage industry, it's looked at as an asset class by many people. And if that asset class cannot perform, then it really depresses the amount of capital that goes into the industry. So it's an exciting time, and I'm glad to see the IPO markets coming back.
Yeah, I have a really risky prediction, and that is that on Friday of this week, we're going to see a tremendously positive skew in the aggregate amount of money raised in IPOs, which is obviously the date that Facebook prices. The Jobs Act is important in a few ways. I should tell you, my background, we haven't talked about, is that I'm the incoming chairman-elect of the National Venture Capital Association, and so I've been very personally involved. There's people who deserve all the credit for the Jobs Act. But when I was back in Washington about a month ago, our lobbyist said to us, Harry Truman's Do-Nothing Congress passed 5 times the number of bills that this Congress has passed, okay? Mind-blowing, the state of whatever that we've got back in D.C. So it's even more mind-blowing that this Jobs Act actually passed. And even the folks who were most directly involved in it, until they got into the vortex of the tornado that lifted them up, didn't expect this bill to pass. But it does show that there is some bipartisanship still left and that people can rally around this issue. And the rest. And so many of these things were intended to open up the gates a bit more to allow companies to go public and take many of the more onerous things out of Sarbanes-Oxley out of it. But I think the most interesting thing going forward, and this is probably where the commissioner was at your office, is that the SEC has been tasked with the job of figuring out this crowdfunding rules. And this really is the ultimate edge of both the law meeting what's going on in society right now, what these companies need to do for fundraising, and fundamentally a set of laws that were passed now almost, 80 years ago under the 33 Act. And looking at that entire paradigm, and does it make sense today? And there's some very profound questions associated with this, and it's going to be very interesting. I know a number of people back in D.C. are very scared about this and what's going to happen. But again, it's change, and it's as a result of that, it's tremendous opportunity too. How it comes out is going to, I don't know, but I got to tell you, it's a very interesting time to get involved in looking at what is appropriate disclosure to protect the public, which is really the mandate of the 1933 Act, leveling the playing field for all investors, but also making sure that we understand, this is something I used to say when I did IPOs. Remember, the prospectus is a marketing document. It was intended as a marketing document. Let's make sure we market the company while providing the appropriate disclosure as well. So we'll see what happens.
Okay, great. Well, unfortunately, we're out of time, but thank you very much for coming, and we're very happy to have you here.
Thank you.